Hi, I'm Nancy Hossack from Ford Asset Management. I'm here today to give a little bit of an overview in terms of what our thinking is about global markets and how we are positioned. So 2022 has been a really historic year in financial markets. There are not many years where we see drawdowns in both the bond and equity market to the extent that we've seen this year. So the big question is, how do we position ourselves and what are we expecting in the next 12 to 36 months? If there's one message that I would like investors to take away, it's that the US labor market is running at very extreme levels right now. One of the metrics we like to look at is job openings to unemployed people. And at the moment, there are 2 job openings for every unemployed person in the US. If you go back and look at this metric over 100 years, what's amazing to note is that it's actually never been at tighter levels. So second only to the current metric that we're measuring was the 1970s. And that is a period that has become infamous for Volcker's fight against inflation. During that period, the Federal Reserve had to hike rates to extreme levels in order to get inflation under control. And even when they got inflation under control, they dropped interest rates and saw it resurge. And so the fight began again. So this very tight labor market is what is currently causing the inflation that we're seeing in developed markets. It's important to note that some of the inflation that we saw in the US started with supply chain issues that we know were well documented during COVID. Some of it was caused from fiscal stimulus, so governments paying people to sit at home and not go to work. That's by definition very inflationary. But what we're now seeing is demand-driven inflation. And what I mean by that is that when you have a very tight labor market, clearly you're going to start seeing wage inflation as different businesses bid up the labor market. So what does that mean? That means that the Fed must hike rates harder and longer if they're really serious about getting inflation under control. And they have to do that to the point where they really break this very, very tight labor market. I think if you listen to the members of the Federal Reserve speak, they will say, and they're very clear about the fact, that the biggest policy mistake that they could currently make is to think that they're getting inflation under control and lower rates too early. They certainly don't want to repeat the mistakes of the 1970s. The concerning thing about it is that if we look at what earnings expectations are in the US, they're certainly not factoring in a significant downturn in terms of the overall economy. So earnings on the S&P are still projected to be up 10% in the forthcoming 12 months. We don't think that this rising rate environment is adequately priced into the S&P at the moment. So if we look at earnings consensus in the next 12 months, earnings consensus is still looking for earnings to be up 10%. There are a few canaries in the coal mine starting to come out with earnings that show that that's a very optimistic assumption. And the one example of that would certainly be FedEx. They came out recently and said that they're seeing declining activity levels across the board and withdrawing all further earnings guidance. We're currently going into kind of third quarter earnings season in the US, and certainly we'll be watching out for further profit warnings from US companies. Certainly something that the market is not pricing in at this point. The concerning thing about this cycle is that this time is different, and central banks really cannot come to the rescue of financial markets if they remain serious about inflation. Historically, in market downturns, central banks have had the ability to ease in terms of quantitative easing and also in terms of decreasing interest rates that have really buoyed markets, and we've seen V-shaped recoveries in many of the big bear markets we've seen in the recent past. If you think that they remain serious about inflation, their ability to pivot is going to be a lot more difficult this time around. So I've spoken a little bit about the US. Certainly that market sticks out to us in terms of being very, very high in its earnings cycle. But what does it mean for other markets? If I compare it to the UK, we see quite a similar picture in the UK. If we look at that metric of job openings to unemployed people, there is 1 job opening for every unemployed person in the UK right now. And certainly inflation is at very, very high levels, very similar to what we're seeing in the US, if not higher, actually. What about Europe? Europe certainly doesn't have the tight labor market that the first 2 have. I think that they have 0.25 job openings to every unemployed person, but they do have a significant energy crisis. So the projections for the year going forward is that the energy bill for most Europeans will be 20% of their disposable income. That's a very, very big number. I think if you just think of your own personal disposable income, 20% of that is a very big number. And we're very concerned about the pressure that that's going to put in other categories in that economy. The good news is, and yes, there is some good news in this message, is that this time around, we are seeing a relatively bifurcated market. And that's good news because in previous bull markets, we tended to see emerging markets and developed markets both peaking at the same time. This time around, we've seen China already well into a downturn that we think the rest of the world is heading into. So China hit the skids about 9 to 12 months ago, and there's two primary reasons for that. The first is the property crisis that started with Evergrande and has proliferated across the economy. And that's really having a big effect on China because around 25% of their GDP is leveraged to residential property. So that's a difficult crisis to manage and certainly is having an impact on overall economic activity. The second reason is the COVID zero approach that the government has taken in China. That is having a big impact on particularly companies that are leveraged to tier 1 and tier 2 cities. So certainly we think that valuations are already well down in China, earnings are well down, and it's a fantastic place to hide. And so you'll see many of the Chinese counters, for example, in some of our global portfolios. So what does that mean for South Africa? Well, we see significant value in the South African market. My one caveat to that is that we have a relatively bifurcated market in South Africa as well. And so when we're talking about where we are in our earnings cycle, it's important to differentiate between financial businesses, industrial businesses, and the resource stocks. So certainly financials are still in recovery mode from COVID. Industrials are sort of midway in their earnings cycle, but resources are very, very high in terms of their earnings margins. And so that's a sector that we are significantly underweight. In terms of valuations, we think that certainly valuations in the South African context are very, very attractive, and we think that that's going to result in very good absolute returns for equity holders over the medium to long term. Having said that, with the liquidity concerns we have in global markets, we do know that sometimes in those environments, cheap stocks can still become cheaper. And so you'll see in our multi-asset portfolios and our equity portfolios, we maintain significant cash balances in order to take advantage of those very attractive opportunities when they arise. One thing I do want to emphasize to investors is that in SA portfolios, we actually have some clear differentiated positions that we think are relatively uncorrelated to SA GDP growth, but we're buying those stocks at very, very good valuations. And we think that that's a source of high returns for shareholders over the medium term. Another attractive opportunity for us in the SA context is actually SA bonds. We have a very benign outlook in South African inflation relative to what we're seeing in developed markets. And the key reason for that is the differential that we'll see in the labor market. South Africans will know we have the exact opposite problem in South Africa to what we're experiencing in developed markets at the moment, and that we have a big unemployment problem. And for that reason, we think wage inflation in South Africa will remain well anchored for now. And for that reason, we think you're going to get some good real returns out of South African bonds with the current interest rates we're seeing on those assets. So despite the heightened risk environment, we are well positioned and excited by the opportunities that are coming our way.